As humans, our responses to uncertainty of outcomes have a significant impact on our achievements. In all aspects of life, we find ourselves showing certain behavior patterns in certain situations over and over again. This is a result of how our mind is wired over the course of time. Psychology is a science of mind and behavior of individuals. It seeks to understand how humans think, feel, perceive, and act in various situations. But wait, this is not a psychology class. We are here to improve our trading consistency. Then why are we talking about psychology? Friends, psychology is that foundational stone on which your entire trading success depends. Haven't you experienced the urge to book profits on a trade when your trade setup suggested to trail stop loss and hold? Or holding on to a losing trade even when your setup triggered an exit sign? All such actions originate from a complex state of mind and have a profound effect on your goals to succeed as a trader. Hello friends and welcome to our channel. In this video, we will discuss about all such emotions and how they affect your consistency as a trader. Before we get on with the subject, a disclaimer. The content is meant for educational purposes only. We are not SEBI registered investment advisors, and the content has been prepared for educational purposes only. The video does not intend to provide any advice or recommendation regarding buy or sell. Trading in financial instruments is subject to market risks. Please consult your financial advisor before making any transaction. Now let's look at what are some of the common human emotions and how they affect your trading performance. Greed. When your setup tells you to book profits and exit, but you decide to hold on for more profits, what happens? The trend suddenly reverses and all the paper profits that you were sitting on suddenly vanish. Fear. When your setup triggers an entry, but you are too scared to enter the trade because you recently suffered a loss on a similar trade. So you're afraid that this trade will also turn negative, but it turns out to be super profitable. Anxiety. You opened a trade and decided to carry the position overnight, but now you're too stressed out because of an event overnight. You are anticipating unintended move in the price. Anger. You're anguished by the recent loss on a trade and you try to trade more just to recover those losses. This is called revenge trading and usually leads to even more losses. FOMO, short for fear of missing out. Now, this fear is different from the one we discussed earlier. In this state of mind, trader usually takes a trade at a point far away from the entry point suggested by their trade setup because they don't want to lose on the momentum of the trend. But the result is they enter a trade on far too unfavorable risk reward. That means they end up taking too much risk for a very small reward. Shock. You're in a state of shock due to unexpected event and your mind just freezes. You are unable to think or act. Now, obviously, there are many more human emotions according to the study of psychology, but we will focus on these primary human emotions for now. I hope you remember this diagram from our video on risk management framework. If you haven't watched it already, I strongly recommend you to watch it to get a complete picture on how the entire system should be designed. The link to risk management video is available in the description of this video. As we can see in the above examples, even if you design a robust trading system and have a solid risk management system, the success or failure of entire structure rests upon your state of mind as a trader. If you are experiencing any of the aforementioned emotions, you are more likely to skip one of the pillars of risk management system and in turn fail the entire system. Okay, I get it. My mindset while trading is very important. But how do I get there? How do I make sure I have a stable mindset while trading? Well, take a break. Take a break from trading periodically, even when you're trading profitably. The data shows that our judgment is impaired when we tend to have streaks, winning or losing. And a pause helps us regain perspective, which is very important after having winning or a losing streak. When we are going through streaks, our mind tends to start getting wired accordingly. If we are experiencing a winning streak, then our mind starts thinking we are invincible and we start slipping on our trade routine. Whereas if you are experiencing a losing streak, our mind starts feeling nothing is working. And then we are too scared to put on the next trade. So a break helps us regain perspective and revisit our models if need be. Engage in other activities apart from trading. Everyone should engage in more than one meaningful activity on an everyday or week basis in our lives. For someone who has been trading as only meaningful engagement every day, streaks tend to leave profound impact on their minds. But engaging in other activities can help them gain a different perspective about their current streaks. The other activities can be literally anything. It could be gardening, teaching, sports, anything. But engaging in other activity apart from trading is very important. Maintain a trade journal. Now, this is a detailed topic in itself, and we will cover this separately in a different video. But conceptually, a journal is where one captures highlights of the day. A trade journal is where one should capture activities done in the market on that day, along with the reasons why those actions were taken. It could be entering a new trade, scaling on an existing trade, or exiting the trade. Along with these details, one should capture how they were feeling at the time of executing each of those actions. This is an introspection usually done in hindsight and can provide valuable data into emotional triggers to certain actions and can help you take steps towards addressing those unhealthy patterns. For example, if every time the price is trading close to your stop loss price and you exit the trade even before the stop loss was actually hit, then your actions could be a result of your emotions and can affect the success rate of your setup. Develop an internal watch guard. Now, this is the most difficult of all. Through meditation and mindfulness, one should develop ability to gauge mood or emotion at specific points of time in real time. That is, as it happens. When you develop this internal watch guard, you will be able to stop and assess if your actions are originating from the setup or from your emotions. This watchguard can also alert you to stay away from trading if you are experiencing emotionally disturbing events in other aspects of your life. Don't get attached to outcomes. Like Lord Krishna has professed in Bhagavad Gita, you have a right on your karma, not on the outcome. Even in trading, don't get attached to the outcomes, that is, profits or losses. If you have tested your setup well and follow it to the last dot, then you will get your results over the period. Focusing on consistency will get you the desired outcomes. Focus on excellence in execution. The success will follow. As the first rule of poker says, leave emotions at the door. That's all for now, friends. If you learned something valuable, give a thumbs up. If you'd like to cover any specific topic, please let us know in the comments box. Do share and subscribe to our channel and have a profitable and risk managed trading. Thank you.